Hey everybody, my name is Kyle Knott and I am not your average finance guy. Today I want to talk to you a little bit about liquidity. So liquidity, I know it's on the board there, the lighting sucks, but how accessible is your money, is your cash, is your investment, whatever it is. So I listed a couple assets on the board behind me there, and so you're the most liquid that you could probably have is your savings account, right? So if you've got a savings account, you can go down to the bank, theoretically, you can go down to the bank and say, hey, I would like my money out, and they will hand you cash right then and there. If it's, I think there's a limit on it somewhere. I don't know. I don't have hardly any money in a savings account, so I don't really know, but I'm sure there's a limit. If you have $100,000 in your savings account, you can't just walk up to the bank and say, I'd like $100,000 in cash, because they probably don't have it on the premises. So that kind of liquidity maybe isn't there, but if you smaller amounts, a couple thousand, I'm sure they've got that on hand, so you get it that way. So savings is very, very liquid. And the bad thing about savings account is they don't pay you anything to keep your money in there. They pay you, I don't know, it's like 0.5% is on the high end. I remember for years and years it was 0.01%. Like, kidding me? Why in the hell would anyone have any money in here? But whatever, that's where they got to. And whatever money you do make on that big interest that they give you is taxed, and most of the times at the highest rate. So there's your savings account, and then your CDs, so your certificate of deposits. That's where the bank says, if you put in X amount of money, X amount of dollars for X amount of years, sometimes maybe it's $1,000 for a 5-year term, they'll pay you, I guess I've seen some maybe up to 4% right now. But back in the day, they used to pay a lot more than that. And right now they're really not. If you only keep them in, most of them are like a year, 18 months, something like that. And the interest rates are still way lower. They're better than a savings account, but it's locked. So liquidity wise, you can't get that money out. Now you can, but you're gonna have to pay a penalty to get it out. And also on there, if you actually made anything, by the time you pay the penalty, you're probably pulling out maybe the same amount that you put in, maybe even less, I don't know. But at that point, if you did make anything extra in interest, you're paying your tax on that as well. Your 401k, so you put money in there, you can't take that out until you're of retirement age. And once you get retirement age, then you are hit. That's just like income. You are taxed at whatever your tax bracket you're at. So if you see a big deal and maybe I'm a real estate investor, say you got your neighbor's house and there's a great deal that comes up and you want to buy it. If you're in retirement, you could take out maybe a couple $100,000 and you could buy it, but now your income just increased by that much. So you got to pay taxes on all that money. So if you're not in your retirement years, you can maybe take out a loan against your 401k. I think $50,000 is the max. So you can take out a loan against your 401k, but whatever money you had in your 401k now goes down by $50,000. And with your 401k, you're locked into a repayment plan. So you can't just go ahead. I don't think you can just go ahead and make a payment of $1,000 a month and then just hand them, say you got $48,000 left and then just pay it off. I think you have to follow the schedule that they set for you. I've never done that, but that's what I think. The IRA is an individual retirement account. A traditional IRA is essentially the same as a 401k. If you're not of retirement age, you can't take the money out without a penalty. Okay, with the penalty, a big penalty and taxes. So, and if you're in retirement age, then adjust your income way up, and you end up paying taxes on all that too. I'm gonna skip down one here to the rental home. So if you got a rental home, hopefully it's producing cash flow and hopefully it's worth more than what you owe on it. So if it's worth more than what you owe on it, you could theoretically go down and get a home equity line of credit to be able to borrow against it. That's going to take some time to get all that set up. I don't know how many you're actually allowed. I think you can only have one on your personal residence and then one on a rental property. That's kind of what I've kind of been told in the past, but I've got one on my personal residence and that's it. I don't have any of my rental properties. But rental income, say it's worth, dumb numbers, $500,000 and you owe half of that, $250,000. So you've got $250,000 of equity sitting in there. But how do you get at that? You really can't. You can sell a house. If you sell it for $500,000, now you got to pay tax on your gains, whatever you paid for it. There's capital gains tax. Depending how that, I'm not a tax guy by any means, but depending on how all that shakes out, there could be big tax implications. You're going to have to pay the realtors, you're going to have to pay the closing costs, you're going to have to pay all these fees, and you no longer have your cash flow anymore. So let's go back up one more to the IBC policy now. If you've got that, I literally get on the computer and I just did it this morning, actually. I had some extra expenses that I was not aware of that came up on rental property, and I needed $5,000 pretty quick, and I don't have $5,000 in that account, so I just brought it up on the internet, and I asked for $5,000 or $4,000 loan is what I needed to put into that checking account, so I had enough to cover those costs. So I think it said 3 to 5 business days. Usually when I do this, it's there within a day or two. So it'll be in my bank account. I can go ahead and pay that bill, and all is good. So IBC is very liquid. It's not as liquid as a savings account, but a couple days. I mean, it's as liquid as the rest of them for sure, if not more. So you've got the liquidity. When I borrow against that IBC policy, I don't have to pay any taxes because it's a loan. Okay, so there's zero tax implications to it. And one other thing that the IBC policy has that none of the other ones do: what happens if you get sued? All right, I'm in the rental home industry, and it's very very clear that landlords get sued a lot. Someone comes over and does something stupid, and maybe a neighbor's dog comes over and bites your tenant. I mean, just crazy stuff. I've got insurance, and I've got hopefully other things in place. But if they come in and you get a lawsuit against you, they see money in your savings account, they're going to take that. They see money in a CD, yep, they're going to 401ks and IRAs are a little bit more protected. The rental home itself, they could force you to sell your home, the rental home that it happened on. It could, if you don't have it structured right, they could force you to sell all of your rental homes, and they take all the profit. So if you've got a lot of equity in all your rentals, then if you get sued, they could force you to sell that for cheap. They don't care because they're getting all the profit, and you're just left high and dry. Now, infinite banking policy is different. That is protected. It's an insurance policy. So I would load that up with all the most money that I could, all my cash value in there, keep that, and take loans against it as you need it. It's liquid, it's protected, it's guaranteed, and it outperforms the savings in the CD for sure with the gains that it makes. I mean, it's guaranteed, and mine's guaranteed at 4%, I believe. But I've gotten dividends on top of that. Last year, it paid out 6.4%. Okay, and these companies, if structured right, have paid out dividends every year for some of them, like I think 177 years. Okay, the people that we work with, they're all well over 100 years, close to 150 years. So long track record of paying dividends. So the payout is good, and you're never taxed on any of it. So liquidity, that's kind of where I'm at. Short video for you today to kind of spell some of that stuff out. So hope this helps. If you got any questions, please let me know. Be happy to help. And good luck, everybody.